All right, let's talk about a real heavyweight battle. Disney versus Netflix. I mean, these are two absolute giants of entertainment, right? They're constantly fighting for our eyeballs and our subscription dollars. But let's look behind the curtain. Past the blockbusters and the hit shows, which one of these companies is actually on more solid financial ground? Today, we are doing a full-on financial health check to find out.
You know, it's so easy to see the billions in revenue they both pull in and just think, wow, they must be untouchable. But the real story, the much more interesting story, is in the numbers they don't put on the movie posters. The real question is, whose business model is actually safer, more resilient? Let's dig in.
So, in one corner, you've got Disney. This is the diversified behemoth. We're talking theme parks, cruise ships, merchandise, and a whole century of beloved content. And in the other corner, you have Netflix, the lean, mean, digital-first disruptor that basically changed the entire game. Two very, very different ways to run an entertainment empire.
So how are we going to do this? We're going to use a three-part financial toolkit. First, we'll look at the break-even point. Then, we'll check out the margin of safety. And finally, we'll size up the risk with something called leverage. By the end, we'll have a crystal-clear scorecard that tells us who's really in the stronger position. Okay, first up, the break-even point. This is the absolute foundation, the first vital sign of a company's health. Think of it like the starting line in a race. A company has to cross this line just to pay its bills. It's only after this point that they make even $1 single of actual profit. So to put it simply, it's the total amount of money a company needs to bring in to cover everything. We're talking salaries, rent, marketing, and of course, the insane costs of making all those movies and shows. At the break-even point, your profit is exactly zero. Anything less, you're losing money. Anything more, you're finally in the black. And wow, when you look at the numbers here, the difference is just staggering. Disney has to rake in nearly $57 billion just to get to zero. Netflix, only about $16 billion. That means Netflix has a much, much lower hurdle to clear before it even starts being profitable. Okay, so we've established that Netflix has a way lower starting line. But what happens once they cross it? Well, that brings us right to our next metric, the margin of safety. This is all about the company's financial cushion. It's the breathing room they have after the bills are paid. Basically, this tells us how much of a company's sales are pure profit versus just covering costs. And a bigger cushion, that means the company is way more resilient. It can handle a bad quarter, a drop in subscribers, you name it, without immediately plunging back into the red. And for Netflix, that cushion is, well, it's massive. 58%. Just let that sink in for a second. That means for every single dollar Netflix brings in, 58 cents of it is made after they've already paid for everything. That is an incredibly healthy spot to be in. This is such a great way to picture what that 58% really looks like. Think about a 30-day month. By day 13, Netflix has already covered all of its cost for the entire month. That means for the next 17 days, every dollar that comes in goes towards profit. And what about Disney? Well, their margin is 38%. Now look, that is still a really solid number for a company of that size. But when you put it side by side with Netflix's 58%, it's pretty clear who has the more comfortable financial cushion. All right, our final metric really gets to the heart of risk. It's called operating leverage, and it's a bit of a double-edged sword. It's all about how much a company relies on fixed costs. You know, things like giant theme parks and massive movie studios that cost a fortune to run, whether you sell one ticket or 1 million. These are awesome when business is booming, but man, they become a heavyweight when things slow down. And we can actually put a number on this risk. It's called the degree of operating leverage, or DOL. A high DOL basically acts like a volatility multiplier for your profits. It means that even a small dip in sales can cause a huge drop in your bottom line, because those big fixed costs, they aren't going anywhere. So for this number, just remember, lower is always safer. And yep, the numbers tell the story pretty clearly. Disney's DOL is up at 2.65, while Netflix's is way down at 1.72. So what does that actually mean? It means Disney's profits are much, much more sensitive to a drop in sales. That massive infrastructure, the parks, the resorts, it means a downturn in the economy would hit Disney's profits way harder than it would hit Netflix's. All right, we've looked at the starting line, we've checked the safety cushion, and we've measured the operational risk. Now, it's time. Let's put it all together on the final scorecard and see the results of this financial showdown. And there it is, all laid out. And it's not even close. On every single one of our metrics, Netflix comes out ahead. A lower bar to clear for profitability, a much bigger cushion once they get there, and a business model that just carries fundamentally less financial risk. It's a clean sweep.
So what's the bottom line here? It's that Disney is an absolute giant, no question. But that incredible scale comes with incredible fixed costs, which makes it a higher risk model. Netflix, on the other hand, is just built differently. It has a leaner, more resilient financial structure. It really goes to show you that being the biggest doesn't always mean you're the most financially sound.
And here's why all of this matters, even if you don't own stock in either of these companies. These three tools, the break-even point, the margin of safety, and operating leverage, they aren't just for Wall Street analysts. They're fundamental concepts that show you the true health of any business, whether it's your local coffee shop or maybe even your own startup idea.
So now you're equipped. You can look right past those flashy headlines and see what's really going on under the hood of a business. So the only question left is, what company's financial health are you going to check next? Thanks for tuning into this explainer.